He's back with us. We've got a little bit of a special treat for this last hour of Bloomberg Business Week Daily. He's joining us for the rest of the show. Jim, it's good to see you. Welcome back.
Thank you. It's great to see both of you.
And thanks for taking the time this afternoon. You know, we obviously weren't planning on starting with Alan Greenspan and his life and legacy. We're going to talk about the Fed. We'll talk about rates, risk, portfolio positioning, the U.S. versus the rest of the world. Matt Miller wants us to talk about motorcycles, but
yes,
I don't think I will be able to do that in an intelligent way that will
I did
suffice.
once ride on it with two other people. That was dangerous. And that was when I was really young.
But we do want to start with Alan Greenspan and the legacy, because early in your career, I mean, he was the Fed chair you knew. He was it.
He was a legend. So if we put this in perspective, and I think it's very important to have context around this, he started his position as chair in 1987. He ended in 2006. That's a 19-year period. So for most people, that's a large chunk of their career. I started in the business in 91, 92. That's all I knew for 14 or 15 years of the starting point of my career. He was somebody that was not going to be challenged easily by other members of the Fed. It's whatever he said went, and that was it. So, but he also did a bunch of different things. He changed things at the Fed in the sense that he made it a lot more transparent, if I could say those words. The way the Fed operated, and we take this for granted today, that you find out on Wednesday at 2:00 what the Fed's decision was, and we all go to work. Prior to Greenspan, it was Volcker. And what happened at about 4:15, 4:10 on a Thursday afternoon, you got money supply data. Based on what the money supply data was, that was the change in policy. You had to figure it out. Nobody told you if it was 25 or 50 basis points. You were guessing, and you were trying to analyze and figure out what that was. So what Greenspan started to introduce through communications and things like that was what today we take for granted was absolutely monumental and groundbreaking as far as saying, hey, by the way, we just hiked or cut 25 basis points, and that's all it is.
Is it too much, though? Like, would some say it's gone too far?
So there's been iterations, like there's pre-Greenspan and then there's post-Greenspan, right? So what happened in the 19 years subsequent, from 2006, say, to 2026, what we've had now is Bernanke, Yellen, and Powell. They've all followed effectively the Greenspan mode, but they added on to it. Now, clearly, Bernanke had a very special situation, the financial crisis. He had to do enhanced communications and things and things of that nature. I think that what is it too much today in terms of communication? I'm going to say that it is a bit. Because what the Fed is trying to do is they're trying to telegraph and televise too much, such that they're actually directing and dictating how the markets should think about things, as opposed to what Warsh said, which is let the markets figure it out. I mean, so the way I think about
Kevin Warsh. So we're being
Warsh,
managed?
Well, I mean, the way I think about Kevin Warsh, if I'm going to put him in this period of time from 1987 to 2026, I'm going to say that what Warsh is trying to do is bring us back to the period that was pre-Ben Bernanke. So it was Greenspan in the 1990s. So very similar economic setup too. Big CapEx cycle, big productivity boom, that we're going through. And I think what Warsh is trying to do is bring us back to that period where he lets the markets assess what monetary policy ought to be, as opposed to what Greenspan did. Greenspan was the guy that really started to come in, because like Volcker and everybody else just looked at money supply, M1, M2. They were, very, very much that's what they did. Greenspan was the one who started saying, we should think about GDP growth and the labor market and inflation, and let's talk about inflation anchoring and all of these various things. Things that we think of today as very common, was very uncommon at the time. So I'd say let's give Kevin Warsh an opportunity. This is his moment in history. He wants to remake the Fed, but this isn't groundbreaking what I think Warsh is trying to do. I think he's just getting back to a period that looks more like the 1990s.
So it's fair to say you see a hint or more of Alan Greenspan in Kevin Warsh today.
Yeah, I do. Now, whenever you compare somebody to like somebody who was a legend and somebody who's just starting out, that's always a very, very difficult. We'll see how Warsh does, right? It's going to be a long journey and long road ahead. But I think on paper, conceptually, what Kevin Warsh is trying to do is get the Fed back to a much more narrow focus. Not as narrow as the Volcker Fed, which was just money supply, but something that's a little more growth, inflation outlook, jobs market, but let's ease up on the communications. I think he's really just going back to a 1990s Greenspan model right now. And that's my perspective. And a lot of people weren't even around in the 90s in this business practicing, right? So they don't really have a good perspective on this. Right. It wasn't chaos. It was fine. You just have to get used to there's a new sheriff in town.
What's the downside of kind of where we are and what we expect from today's Fed?
I think the downside is that there's a lot of mission creep with the Fed, right? So now we have to put this in context as well. Prior to the financial crisis, we had this much more narrow remit. This is what Greenspan kind of created. I mean, he opened it up, more transparency. Then Bernanke kicked the door wide open. He had to. Mm-hmm. We had a financial crisis. We had interest policy. We had QE. We had policy rates at zero. So he had to find a way to communicate policy to the markets. I totally get it. But what happens is that once the Fed starts to have this mission creep and they start to be asked to do more and more, even from a regulatory standpoint, or even, the Fed was being asked, what's your policy on climate, things like that. This is not what the Fed's job is. The Fed, and according to Kevin Warsh, should color in a very, very narrow set of lines and stick to what their job is. Under Volcker, it was money supply.
But what if the economy has gotten more complicated? Climate change is an issue. Companies have to think about it, because it is ultimately going to impact their bottom line.
But does it affect a dual mandate, I guess some might say?
Well, it might, because people can't work. Yeah.
You can extrapolate, right? So what Warsh is basically saying is, don't ask me that question. Yeah. That is an elected official's job to do. My job as Kevin Warsh, right? If you're Kevin Warsh, if you're the chair of the Fed, is price stability and full employment, and to really focus on the price stability component.
But don't you sometimes need, I'm going to get into trouble, by needing a figure that's not political? But we understand that politics has certainly crept its way, Jim, into the U.S. Central Bank. But I think there are times we look at the Fed chair, even if there is a political backdrop, as being kind of a voice of reason on all of these major issues that will impact economic growth globally, will impact corporate bottom lines. Is it not important to have that voice of reason?
It is absolutely important to have a voice of reason, but in a position like that, in the way that I believe that Warsh interprets it, is that it's a very narrow remit. And one of the things that he said is that the Fed should have absolute independence on a narrow set of items. Everything else, this is what the Fed is. This is not what the Fed does. And I think keeping that very, very clear and setting these boundaries, right? Yeah. We all have to set boundaries, right? This is a very important aspect of things. Is like, look, don't ask me these questions. I mean, these aren't questions that are for Kevin Warsh, right? So that's what he's basically saying, and what he says ultimately is that the Fed can do its job better if it's just doing the job that it was tasked to do, but is not being asked to solve all these other problems.
In the words of Jay Powell, we'll stick to our knitting, is what he said over and over again.
Exactly right.
So it just reminds me of that sort of go-to for him. We're speaking with Jim Caron, the CIO of Portfolio Solutions at Morgan Stanley Investment Management. So what does all this mean for rates under a Warsh regime?
So
it was pretty clear.
Yeah,
he was, and the market reacted in a very clear way.
Or was he?
Well, yeah. So I have a very out of consensus view on this. Okay. So I actually think Warsh was more dovish than what the markets thought. Okay, so I know what he said, and in a traditional interpretation.
So markets got it wrong.
I think so.
Okay.
So effectively, under a Bernanke, a Yellen, and a Powell, if that's your mindset, and say, look, traditionally, if I think about what Warsh said, and I use that framework, Bernanke, Yellen, and Powell, then yes, he was absolutely very hawkish, right? There's no question. Yeah. But I think if you read between the lines and listen to what he's really saying, what he's saying is that he's going to create these task forces in terms of so how do we think about the data? So if you were to ask me a week ago, 2 weeks ago, what is the Fed's most favored measure of inflation? I'd say core PCE. That's the Fed's favored measure of inflation. Today, I don't know what it is. I don't know what the task force is going to say that it is. Is it year over year PCE, or is it month over month, or is it 3 month over 3? This is what the task force is going to figure out. So the market, I think, for the next 6 months until this task force gets this all done, is going to be very confused as to what the inputs are to the Fed's large-scale policy model, which is their what they call the FRBS model, Federal Reserve Bank of the U.S. model. And what Warsh is doing is he's not saying I'm going to change the model. What he's saying is I want to look at different inputs. I want to look at labor data in a different way. I want to think about productivity differently. Kevin Warsh is a supply-side economist. He's going to start to create a lot of supply-side indicators to inform him, as opposed to the more traditional demand-side components of the economy and those indicators. This is, in my career, and I've been doing this since 91, 92, so about 34 years, is the most monumental shift that I've seen take place. I inherited Greenspan. When I started, Greenspan was there. That's all I knew. This is a major shift, and I think that people are underestimating how monumental of a shift this is, and where they're going to get it wrong is by applying what they've learned over the last 25, 30 years under a Greenspan to then say, oh, well, this is how I would interpret this. I think the rules are, the ground is shifting. Not the rules have changed, but the ground is shifting.
So good that it's shifting? Good that we kind of take a look at a system that we've been kind of moving along for a long time?
Well, I mean, changes happen, right? So Greenspan changed it, right?
Yeah.
Like when he came in, because he felt, and you mentioned yourself, the economy has changed. Right. So when we look at labor data and labor statistics, I think the data has been challenged for the last 5 years. The non-farm payroll data, for me, used to be the sun rose and set on the non-farm payroll data for me for most of my career.
Yeah.
Last 5 years, not very informative. Weekly jobless claims were a bit better. So I think there's a lot of challenge to the data.
So what's the best? I mean, there's no single best piece of data, but what's replaced the non-farm payrolls for you?
So this is what Warsh is trying to figure out in terms of looking at is using this task force, right? So you've got this other series, this quarterly census of employment and wages, the QCEW series. This is the thing that constantly gets revised or revises down the monthly non-farm payroll numbers and things like that. So what I think Warsh is going to try to do is use more real-time estimates of the market and to try to understand whether it's inflation data, maybe even shorter-term measures. I'm not saying that we're going to live and die by the weekly jobless claims number, but I'm just saying, you've got JOLTS, you've got these other surveys, you have other industries that create surveys of data as well. Why not start to look at this a little bit more broadly?
Well, it's interesting that you say that, because we get PCE this week, right? And Warsh is not so keen on this read in terms of inflation. Is he right? And is there something to maybe rethink about this 2% target that we obsess about, that maybe that doesn't make sense because we can't seem to get there?
Yeah. No, I mean, this is, same thing in the 90s. We didn't really get to 2% as a target either. We didn't even really have the target of 2% at that time,
right.
Which is another thing. So maybe, as I'm saying, as Kevin Warsh is kind of going back to the 90s, maybe we should think about the target. Is it more of a range, or is it a specific point target? And the other thing that I think is going to be very, very different is that the traditional way over the last 25 years or so that we thought about controlling inflation was to adjust the jobs market, right? So if inflation's running too hot, this is the irrational exuberance. How do you control inflation? You kill the jobs market, you create a recession, you get the unemployment rate up, you get prices back down, and you tamp down inflation. What Warsh is saying is that if you're in this period of higher productivity, then lower levels of unemployment, so an unemployment rate that, say, falls from 4.3 to 3.8 or something like that, doesn't necessarily mean that it's going to be inflationary if it's because you're getting higher productive growth. That's a very supply side view of the world. And basically saying that if industry is creating more efficiencies, that doesn't necessarily create a higher inflation rate. So a lot is changing. And, it's a lot of people should really just, when they speak to say, look, I'm not really sure, but what I think is, as opposed to being so definitive. So I'm keeping a very open mind about all of this.
Does AI completely change everything that we're talking about?
Possibly.
Possibly, I mean, I think the issues with AI that I have in economic forecasting is that it's kind of just going to look at the survey data. It's going to look at the available data sets that are out there. Unless you train it to look at specific
I just
things.
mean from productivity perspective.
Oh, yeah.
That's what I mean.
100%. Yeah, I see what you're saying.
Yeah, not on the data analysis, but just
Yeah.
on productivity and what it does to this economy.
So in my view, it does, right? So I think the productivity, I think you're going to get a lot, I think you can get higher levels of growth and lower levels of unemployment, but if it's more productive because AI is becoming more efficient, is going to be it's going to be a positive. So when we think about AI, people think about it in terms of profit margins, right? And today the way they think about it is it reduces costs. So more AI, less junior analysts, higher unemployment rate, and that's kind of the negative view of AI.
Yeah.
I don't think it's going to work that way. I think what we're going to see is you're going to have more AI. It's going to create more demand. It's the Jevons paradox, right? Where when something becomes cheaper, you demand more of it, which is what I think AI is going to do. You'd have more people asking critical questions of this tool called AI, and we're going to be judging the results of these things. And ultimately, if you get better, more efficient decisions and higher productivity, these are the companies that that actually use this. These are the winners. There's a lot of creative destruction here. There are going to be winners and losers.
Yeah, I agree. Do you think that means that some of the companies we talk about nonstop could be a possible loser down the road?
Yeah, absolutely. Right. So it's all about adapting. And it's looking at companies that can actually use this tool very efficiently. So right now, there's a big productivity gap between the way that we evaluate this, right? We're just in the infancy of all this stuff, right? So if you ask any individual person, hey, do you use AI? Yes, I do. Are you more productive because you use it? Yes, I am. Okay, now go ask the CEO of that company. If your employee is 30% more productive, are your profits 30% higher? And they're going to say, I don't think so, not yet. Over time, that gap, that productivity gap, is going to narrow relative to the individual being more productive and the company becoming more productive. Companies right now don't quite know how to use this tool efficiently or effectively.
But I think the concern that a lot of people have is that, well, maybe when an employee leaves, that employee doesn't need to be replaced by headcount. And it's the margins where you'll see. And fewer people producing the same amount of work, great for shareholders, not so great for those folks with jobs.
Yeah, it could be, right? So my take on it is that the real power of a powerful user of AI is somebody who can ask really good, creative, insightful questions. So the work that, whether it's software, it's programmers, engineers that create a lot of the software, a lot of that work is going to get displaced, I think. But the people asking the questions, the more creative questions that come in that try to solve problems, I think that doesn't go away. And then you have to judge it. You have to interpret it, and then you have to apply it. And I think that's where the job growth is actually going to be.
So maybe that liberal arts education
100%.
makes it.
Hey,
100%.
You're talking to a Bowdoin guy here
Yeah.
and a Colby guy
Yeah.
here. So
100%.
we're getting along right
100%,
now.
yes,
But,
exactly.
Bowdoin girl here.
Yeah.
But no, but I think about that a lot. Like learning how to ask the right question. And we keep talking about this too. It's not these basic, simple questions. It's really complicated, smart, thoughtful questions. And
the critical
having a
thinking that you
conversation.
develop when you're writing those papers late at night that now AI is writing for you,
Yeah.
unfortunately, so the kids aren't learning how to do it.
Well,
Yeah.
think about it. I mean, you may not be able to code, but you can ask a lot of really good questions, right? So there you go. I mean, and if you can ask really good questions, well, don't worry about it. The machine's going to code for you.
Exactly. If you have a vision for something,
Right.
because you have an analytical mind,
Right.
you have an idea for creating something, you no longer need to find that person to code for you. You can get
right.
Claude Code or Codex from OpenAI to do it for you.
So Albert Einstein said that the true measure of intelligence is imagination. It's not all these hard technicals. It's as if you're very imaginative. That's actual intelligence. I'll go with Albert Einstein on this one.
Yeah. It makes us think, there are people who've been writing things about, you have to give your mind, your brain kind of a moment to think, right? Some space to think rather than kind of nonstop, either on a computer or on your phone and thinking things through. Having said that, we've got about 4 minutes. We're going to take a break and come back and talk some more because I want to address some of the things that the president has been saying. when it comes to the spend that we see nonstop, and we've been talking a lot about SpaceX now tapping the debt market. I don't know, how do you work that into the investment narrative? Is it smart? Do we get nervous? We just had our credit analyst on and kind of all in on Elon and comfortable with it, that we don't even know where this is all going. But if you're going to bet on someone, this guy seems to make sense.
Well, look, I mean, things are going to go in cycles. There's no question about this. So there is a large spend right now, and everybody's going to ask the question, is the juice worth the squeeze, right? We're spending a lot of money. Are we going to get the profits, or is this going to happen? I think it will. It's going to happen over time, but it has to be an enterprise solution, meaning that companies, corporate America is who's going to build data centers in space, for example, right? It's going to be the need from business that says, hey, I've got a whole team of people that I just hired, and they're using this AI engine, this AI tool, creating agents nonstop, and their productivity is off the charts. We need to do more of this. It's an enterprise solution that's going to actually create the profitability, and I don't think we're close to it yet, because right now you're asking CEOs like, oh, so is this profitable? Like, yeah, I think it is. I mean, they're not quite sure how to measure it.
Well, the flip side of that is some CFOs pulling back on those tokens because they're not necessarily seeing the ROI.
Expensive.
Uber, for example,
expensive.
Yeah.
It's a cost component, but like anything else, you know, tokenization is going to get commoditized. It's going to become cheaper. Do you remember, like, oh, don't print in color, right? You can't print in color because if ink was more expensive. Nobody really says that anymore, right? You know, so I think it's one of these things that it's so like, funny. You know, I think it's going to get cheaper.
What did I tell you, Carol, when I started working here 6 years ago? I was like, I like working here because they don't count how many pages you print in color.
So
as opposed to where I used to work, and they're like, do not print in color.
Or do not print at all.
Yeah, exactly.
Just read off of it. Yeah. You know, it's funny when we talk, and I feel like, I mean, we don't know what the time frame is here, do we?
Nope.
We really don't. We're taking it day by day, week by week, month by month, in terms of just kind of watching how this, you know, evolves. But what I do find interesting, and we mentioned ROI, like our conversations have evolved a lot more to talk about that when we're talking about artificial intelligence. We weren't doing that necessarily a year and a half ago.
Yeah, so I think if you look at any business cycle, right, you've got the early adopters, you've got the late adopters, right? It's never a straight line. It's never like you're early, then all of a sudden you kind of get there. It's always exponential. So you start off, there are going to be some early adopters. The way that the market's going to identify that is these are the companies who are going to get rewarded.
So, Jim, just
early adopters.
Early adopters.
Well, yeah. I think it's fair to say some of those are getting rewarded right now.
Yeah, exactly.
But apart from those companies, the developers of the frontier models, the hyperscalers, and just in the last 45 seconds we have with you before we take a break and come back, who else could be winners? Where else could you find winners?
I think you're going to find it all across the spectrum. You know, it's not a question of specific industries. It's really a question of which companies in which sectors are adopting these tools and unlocking operating leverage. That's going to happen in healthcare. That's going to happen in industry. That's going to happen in software and technology. It's going to happen all
financial
across
sector.
Financial sector. Financials are pretty efficient, but I would say, but even still, financials. You know, these are all managed care networks, which are very cost intensive, very heavy. Workforce intensive. And the companies that do this right they're going to unlock a lot of operating leverage, and those are cash flows I want to buy. So I don't think there's any one sector, one company.